Hello guys and welcome back to a new video. Today's subject is liquidity pools. Alright, one of the most important concepts or subjects in trading. Alright, I don't care what style you are using, what system you are using, being aware of liquidity pools and how they work is essential in my opinion. And I know a lot of traders from different schools and they all somehow incorporate what I'm going to show you in this video. So this is going to be straight to the point video. All right, I'm not going to waste any more time because sometimes I'm talking about something and then I drift away and then suddenly I'm talking for 30 minutes straight. So it's going to be straight to the point. All right, so let's start first of all with what are liquidity pools. All right, the concept is extremely easy to understand. You can see it on the chart easily. Naked price action. You don't need anything else, although you can, but you can basically see it with naked price action. And you can also easily identify high probability liquidity pools from low ones. All right, but the key concept here is to be patient. All right, and to have the discipline to wait for those and to not take low probability ones. All right, so first of all, what are liquidity pools? Basically, they are price levels where a large cluster of orders is waiting. All right, there's going to be a large cluster of orders. It can be buy limits, sell limits, people aggressively entering. So usually stop losses from losing trades. If we're going to talk about a bullish liquidity pool, it's going to be stop losses from people who are longing. All right, and it can be pending orders from traders trying to catch a move, and they often form at obvious highs and lows. All right, because that's where the crowd agrees. All right, it's an obvious high or low. There's going to be people buying. If we're going to talk about low, all right, there's going to be a lot of people buying on that level. There's going to be people selling on that level, breakout traders, support and resistance traders, big institutions buying on that level, all right, fueling their big trades. There's going to be institutions defending their orders, all right, maybe they took a long, price forms a low later on and then revisit that low. Big players, they're going to defend that position at that major low. All right, you're going to all see it on the chart later on. So the big players target these areas because triggering those orders creates the fuel needed to move price. All right, I don't care what you believe about there is a single algorithm moving price around. If you think so, then you're an idiot. All right, if you think there is one single algorithm moving price from one level to another, and that's just a marketing stunt, right? With all due respect, but think of these liquidity pools or these levels as a gas station. All right, a gas station for the market. And listen to what I'm going to say carefully here. When price taps them, it gets the energy for its next move. All right, I'm going to repeat and I want you to focus on the word energy. When price taps them, it gets the energy for its next move. Energy. All right, we're going to see an explosive move when price taps into this levels, and this is one of the key points that you're gonna identify whether there is or this is a high probability liquidity pool or not. Energy. All right, now I'm gonna show you the types of liquidity pools. All right, and then I'm gonna show you how you can spot them and finally how to trade them. All right, so as I said, liquidity pools are highs and lows, swing points. All right, not the exact point but below or above. That's where you're gonna find the largest liquidity pools. All right, so if you're gonna talk about a higher time frame, and I'm gonna show you why higher time frame liquidity pools or higher time frame swings are way better in terms of price action and less manipulation than lower time frame liquidity pools. Of course, price is fractal, but the degree is not the same. So it can be previous daily highs, daily high or daily low, all right? Previous weekly highs or lows, monthly highs and lows, or basically just major swing points, major visible swing points on 4-hour, daily, or weekly. Now, why did I mention these and why I'm putting emphasis on the higher time frame? First of all, higher time frame swing points and liquidity pools, they attract multi-time frame participants. All right, you have intraday scalpers, swing traders, institutions, big players in the market. They attract all of them. Where, for example, if you have 1-minute liquidity pools, you can still have willing participants in that area, but not like the higher time frame swing points. All right, in the higher time frame, there's gonna be a deep liquidity below or above them. All right, and the reactions from these areas tend to be sharp and sustained. All right, and you're more welcome to go and backtest this. Now, if we talk about lower time frame liquidity pools, all right, those that we can see from the 15-minute all the way to the 1, all the way to the second charts, all right, we can have the pre-market high and low, we can have internal range swing points, it can be the data low or the data high, all right, especially the data low and the data high. A lot of times price attacks, comebacks and attacks that high or that low, especially if it's not aligned with the higher time frame. So for example, the higher time frame is bullish, all right, everything suggests bullish, and then NFP hits, all right, and there's a huge move to the downside, and then price starts climbing back, all right. Your target should be the high that initiated that big move to the downside. 80% of the time price will come back and takes that. So this can be used to engineer setups that align with the higher time frames. All right, now as I said, the types doesn't matter. What matters the most is how you can spot them and how you can trade them. All right, so in order for you to spot them, which is extremely easy, you need to focus on the obviousness. All right, you need to focus on the obviousness of the liquidity pool, because liquidity is built where the crowd sees the same thing. All right, you need to see something obvious, so you don't sweat to find that. All right, you don't scroll through exotic time frames, you zoom in, you try to find that hidden low or hidden swing that you want for price to takes it and then maybe reverse from there. No, your best shots will be when price takes an extremely obvious high and low. So follow this process. The more obvious, the more stops sit there and the bigger the reaction. All right, now from my experience, and I did a video about this, price a lot of time, all right, it reacts from swing points, from highs and lows, but the strength of that reaction varies. All right, internal swings can be weak to medium reactions. By internal, I mean for example, let's say from here between this low and then this low. All right, this is an internal swing, this is an external swing. These two can offer a reaction, but the strength of the reaction will vary from one low to another. And I'm gonna show you with examples. All right, so for example, let's focus on this one. All right, if we put some drawings right here, let's suppose that price is right here. All right, you can see that if we start drawing potential liquidity pools, like I said, if you're bullish, you want to spot and mark up the lows. We can consider this as a low, this one maybe. We can consider this as a low, this one, right, a swing point, and this one. But in your opinion, which one do you think that it has the potential to give a strong move to the upside? All right, the obvious one. Let's talk about the obvious one. All right, if you're here, this right here is the obvious high between, or the obvious low between all these right here. Again, you want to look for something obvious, and you can see that price after it takes this, although it doesn't look like a swing point right here or a low. If we go to the 4 hour, it's gonna be a low right here. Let's go to the 4 hour, and so there you go, you can see it here. Let's go back to the daily time frame. So we have this one, we have this one, we have this one, and we have this one. You can see that price tends to have reactions from pretty much all the lows or the highs. But again, that reaction will vary, and you need to focus on the obviousness, as I said before. And remember what I said, when you hit a high probability liquidity pool, and by high probability I mean that you're looking for that big reaction, all right, when price just snaps from there. You can see when price taps into this, we have a small reaction to the upside, right? Look at the size of the candles, but look what happened when price trades to this low. See the candle afterward, all right? See this big shift to the upside. There were orders that were triggered from here, all right? It can be pending orders, limit orders, all right, and stop losses that fueled those buys, those longs, all right? So basically there was an imbalance right here. There was only buyers on this move right here. So no willing sellers from here. Everybody got stopped right here. So what's left? The buyers. That's why we have this move right here. Now notice what we have here also. Suppose that you are here, price is trading to the downside. Now, just to clear things up, after price takes this, and this is a liquidity pool, or this is a real liquidity pool, it doesn't have to initiate another trend and another expansion to the upside, all right? But this reaction, we're not going to trade the daily, we're going to trade the lower time frames after we spot that liquidity pool. So this move to the upside, it's a weekly trend, all right? Now, suppose that we are here, price is trading to the downside, we have the low from here, this an internal low, we have this internal low, and then we have this low right here, obvious low. Now, just because we took liquidity from here, right, we tapped into here, that doesn't mean that we're not gonna revisit it, all right? It happens all the time. But notice here, we have this small reaction to the upside, you can see, after we took this low, this liquidity pool, but still, sellers were still in control right here. That's why we have only this small move, all right? Now, after we took this, I want you to notice the reaction and remember what I told you before in the beginning of this video, all right? That analogy that I gave you. Think of the liquidity pools as a gas station for the market. When price taps them, it gets the energy for its next move. And notice the energy right here after we tapped this one. See the candles and see this candle right here. Now, that energy didn't start from this candle, it started from this candle. This candle opened here, all right, traded all the way to here. So traded all the way to here and see the sudden reaction, all right? Price put in the low and quickly traded to the upside, all right? That's a big trend on the 1 hour, maybe. Let's go and see it. So this is why I told you that it didn't happen on that candle. It started from that bearish candle. See the candles, the size of the candles, and quickly V-shaped recovery. This is why this is something that you want to pay close attention to. All right, difference between a liquidity pool that's gonna push price to the upside, give you a decent reaction, and something that is temporary, all right? You're gonna see strong move to the upside. Now, notice when price took that external or internal low, see that price just lost momentum right here. We have a strong reaction from here, but just lost momentum, and this is not something that you want to be to participate in, all right? When you see this slowly trading to the upside, don't expect a push to the upside suddenly, all right? Came back all the way to here, and then see the candles here, all right? So let's go back to the daily time frame, and you can see this all the time, all right? You can pick any chart, you go to the daily, go to the 4 hour, the weekly, and notice what I showed you right here. In my experience, price will react from almost all swings, all right? But the external swings, it's going to have strong reactions, often trend reversing or trend setting. Let me show you another example. All right, here, this is a good one. Suppose that you can notice here the internal lows and the external lows, all right? We have this. Suppose that we are in here, all right, and we are trading to the downside. You want to note all the external and the internal lows. Those are liquidity pools, but again, not all liquidity pools are equal. So see what happens. I want you to notice the reactions from these internal lows, and also, right, multiple reactions. But notice what happened when we took that obvious, all right, emphasis on obvious external low, big push on upside, all right? So there was a lot of participation from different traders. Now this right here can also happen on the upside, but I'm only talking about pro trend, right? Show you also these, and you're gonna start looking for against the trend, because against the trend, guys, you're not gonna have the same success when going with the trend. So for example, see what happened here. Yeah, we traded the downside, but see the move to the downside. It's kind of choppy, ugly, all right? So you want to focus on the pro trend liquidity pools, all right? Let me show you another example that happened here. See the reaction, for example, between price taking the low from here. So the reaction can be a really good indicator to know if this is good or not. You can call it displacement, whatever. See, for example, this candle, it didn't even trade above this, so it kind of stayed where it is, and then just small candles afterward. But when we took this big candle, engulfing, whatever, and then small consolidation on the weekend, and then continuing to the upside. Let me show you another one. Alright, this one is good. Suppose that we are trading to the downside here. Alright, one more time, starting trading to the upside. Alright, and now we can see that the internal lows, liquidity pools, it offers that reaction. Alright, if you want to study what happened here, you can do your own research. So asking questions like, why this is happening? What happened here in order for price to trade to the upside? Why did price reacted? And why the energy right here is not the same as here? Alright, these questions, I'm not gonna talk about them in this video. It's gonna take me forever. So do your own research and try to find legit sources. Alright, so see the reactions from the internal lows, and then when we hit the external low, big move to the upside. Alright, one more time, see the internal low right here, and then the external low. Alright, so can you see it? So now after I talk about how you can spot the liquidity pools, now let's talk about how you can actually trade them. Now I'm going to talk about how I personally trade them. I don't know about other methods. Alright, I'm sure there are different styles of trading this kind of levels, but for me, I either use them for entries. So what I mean is that when price takes, I don't know, this for example, I'm not gonna go to the lower time frame. I'm gonna try to find an entry to participate in that. Now that's valid, but it needs certain rules. For example, respecting the time frames. So for example, if this is the daily, you want to go, for example, on the 1 hour right here to look for entry. So you don't go to the 1 minute. You're gonna get stopped out, and still price moves in your favor and in that direction. All right. Another way you can use them, and this is, for me, is better because you can get multiple chances, is that you use them for directional buys. All right. So if price takes this, I know that the next, or that particular day, or the next 3 days, 5 days, dependent on the degree and what kind of liquidity pool that we took. So for example, if we took this obvious low, all right, I'm expecting a decent move to the upside, maybe to that high, maybe to this, I don't know. But let's take, for example, these consecutive candles. So this gives me the whole buys for that week, for that day. I'm gonna look for only longs. All right, I'm gonna enter a long, exit, come back to the market looking for another long because this is still valid. All right, so this gives me the confidence to scalp this, even if I'm scalping, because I know that if I'm positioning myself with this kind of moves, I know that my TPs are gonna get hit cleanly, easier. All right, price will not do deeper pullbacks into my stop loss, not a lot of manipulations. So this candle right here, you see this, it's quite big. All right, this is gonna be a nice trend on the daily time frame or intraday. All right, 5 minute, 1 minute, this one also. All right, let's go to this one, for example. Let's see, check the trend that happened here. All right, you can see, for example, beautiful, nice move to the upside. For example, here multiple entries were provided, shallow pullbacks, strong trend. This is the kind of sessions that you want to participate in. You see this nice trend, it lost momentum, but still really good highs and lows, right? Not a lot of manipulations, so you can easily trade this. But as I said in the start of this video, it's not hard to identify and master liquidity pools, to spot them and so on. But the hard thing is to actually wait. All right, you wait for those levels to get hit, because you can easily, you're planning to trade from this level and then you see price takes this low and you might, all right, you can't wait, let me look for longs, price it might leave without you. All right, this is also a big concern, and the fear of missing out. You might think that price can taps into this low, this liquidity pool, and then from here it will go all the way to this high, and you're still waiting for that low that will never get hit. All right, this is, yeah, this is can hurt. All right, but there's always going to be another chance, and just understand that the price that you're going to pay for chasing price is going to be far more than not trading for that particular week, because price never traded to that level of yours. This is why, if you want to really have, or at least to minimize that fear of missing out, you can add another asset or add 2 of them. You're only watching 3. You're gonna go to the higher time frames, mark up those higher time frame or high probability levels that price will likely to have a decent reaction from, and you just sit still and wait for the alarms or the alerts to get hit. They're not going to happen at the same time, so you're not going to have to watch multiple trades or watch multiple charts every single day. All right, you're just waiting for that particular level, high probability level, to get hit. That's it. Your win rate is going to increase. All right, you're going to be more patient now. You're not going to have the fear of missing out. They're not gonna, all of those 3 assets that you're watching, they're not gonna just leave without you, all the 3. All right, so just sit still and wait. Now for the final part of this video, I'm just gonna give you some extra notes, all right, that you should consider. Some of them I already talked about them during the video, and I'm sorry I did say that I'm gonna be quick and straight to the point, but I just drift away again. But let's talk about the extra notes that I made. So, for example, time of day does matter. I'm not talking about macros or whatever. By time of day, I mean look for those liquidity pools to be traded into during New York or London. Depends on the asset, all right? So don't look for them after at 5 p.m. or 6 p.m. or even the Asian session, all right? Because those big reactions, they often happen at New York and London, all right? That's one note. Another note is that low probability liquidity pools, you can identify them by measuring the strength of that reaction. So if price fails to react strongly after a pull is taken, it often means continuation in that direction. So for example, price trades to here and you don't see this big displacement or V-shaped recovery. So for example, we have you can also notice this pattern. It happens a lot. So when we are approaching to take that level, that pull, we have a quick move to the downside. So we don't have that slowly price grinding down to the downside. All right, we have a quick move to the downside and then followed by a quick move to the upside. All right, it happens all the time. All right, this is just a pattern in price. For example, you can see here just a quick move to the downside, all right, and followed by a quick move to the upside. But again, this is an external or an internal low, so you don't expect a move to the upside even if these conditions are checked, all right? So suppose that price is trading here and slowly trading to the downside, all right? Slowly, all right? It takes that low and then maybe you have a reaction, but price is slowly trading to the upside. You really don't want to enter or to consider this a major reversal point, all right? A lot of times price will continue like this, all right? Because it didn't have a strong reaction and it kind of contradicts the logic of a liquidity pool where we have a lot of orders, a lot of willing buyers from here, stops gonna get triggered, liquidity, all right? The sellers are gonna offer liquidity to the buyers. Sellers eventually they're gonna liquidate it and lose interest from here. So it should be only buying and we should see imbalances, a lot of imbalances, all right? This is what you want to see. But if you see price hitting like this, yeah, you don't want to participate in that, as I said. So that's another note. And the final note, I already talked about this, is patience, all right? The stronger the pull, the longer the wait for it to get hit. So let the market comes to you. Now, I believe that this is the end of this video. If you have any other questions, you can always DM me on my Twitter account or leave a comment down below and I will answer you as soon as I can. Now, happy trading and good luck.